You know, when a company that's basically the size of a small country hits a wall, it makes a sound. And for UnitedHealth Group, a true titan of American healthcare, that sound was a massive crack that echoed all the way down Wall Street. So today, we're going to break down the anatomy of this corporate crisis, what went wrong, why it matters, and the huge effort that's now underway to try and fix it. So, this is the company's new CEO, Stephen Hemsley. And this statement, well, it really cuts through all the usual corporate talk, doesn't it? It's a surprisingly blunt admission that, yeah, the company had lost its way. It really sets the stage for this dramatic story of diagnosis and, well, an attempted recovery. But, you know, a CEO's words are one thing. This number, this is the cold, hard reality. $16. That's the new adjusted earnings forecast for 2025. Now, for a company that Wall Street expected to be just firing on all cylinders, this number was a total gut punch. It signaled that the problems were running way deeper than almost anyone had imagined. So, what happened? Okay, so how did this whole crisis even begin? Well, it wasn't with a whisper, that's for sure. It was a bang, a sudden shock to the system. Basically, a public admission that the company's internal compass was completely broken. I mean, just think about the whiplash here for a second. In May, the company pretty much told investors, yeah, we don't know where we're going. Then, just 2 months later, they come back and say, okay, we've got a map now. But the destination is much, much further away than we first told you. This two-step reveal, it just created this massive cloud of uncertainty and pointed to some really fundamental breakdowns. So what was the first domino to fall? It was a massive miscalculation. The company's core insurance business, UnitedHealthcare, they just did not see this absolute tsunami of medical costs heading straight for them. The whole problem really boils down to this one devastatingly simple error. See, UnitedHealth priced its super popular Medicare Advantage plans, assuming the costs would go up by about 5%. The reality? They're actually jumping by 7.5%. Now, that 2.5-point gap might seem small, right? But when you apply it to millions of members and billions of dollars in claims, it becomes a colossal financial black hole. And you don't have to take my word for it. Here's the head of UnitedHealthcare, Tim Knoll, confirming it directly. No complicated excuses, just a really candid admission. We got the math wrong. It's that simple. They didn't charge enough in premiums to cover the exploding cost of care for their members. And the scale of that error is just staggering. It's a $6.5 billion problem. And it wasn't just in one area. Medicare took the biggest hit, sure, at $3.6 billion, but their commercial plans were off by over $2 billion too. This wasn't some localized storm. It was a hurricane hitting their entire insurance portfolio. But the pricing mistake, that was only half the story. The company's other safety net, its supposedly flawless growth engine, Optum, well, it suddenly started sputtering at the absolute worst possible time. Just look at this collapse in profitability. Optum Health, that's the part of the company that owns clinics and employs doctors, saw its operating margin just free fall from a healthy 5% all the way down to a projected 1% in only 2 years. This proves the problem wasn't just about bad math, it was about bad execution. So, what went wrong here? Well, it was kind of a perfect storm of issues. They totally underestimated how a new government payment model, this thing called V28, would cut their funding. At the same time, they took on a flood of new patients who turned out to be much sicker and more expensive than they expected. And internally, the company even admitted to suboptimal performance and self-inflicted challenges. It was just a failure of execution on multiple fronts. Okay, so with the diagnosis crystal clear, what's the prescription? UnitedHealth has laid out a tough, pretty aggressive turnaround playbook, an agenda they're calling reform and change. Here's the plan, and it is not subtle. First, they're going to aggressively jack up prices for 2026, planning for an even higher 10% medical cost trend. Second and third, they're shrinking their footprints. They're narrowing their networks and completely exiting plans that cover over 600,000 members. And finally, a relentless focus on efficiency. It's basically a strategy of getting smaller and more expensive in order to get healthier. But listen, anyone expecting a quick fix is in for a really long wait. The company is making one thing crystal clear. This is going to be a multi-year road to recovery. Here's their own timeline. 2025 is the year they hit bottom and reset everybody's expectations. 2026, they say, will see some solid but moderate growth as the turnaround plan starts to take hold. But it won't be until 2027 and beyond that they expect to see their performance truly begin to strengthen and start climbing steadily upward. So that leaves us with the big question. UnitedHealth Group has a clear diagnosis of its problems and a pretty tough prescription for the cure. But in an environment where healthcare costs just keep rising relentlessly, can this titan really execute its turnaround, regain its footing, and rebuild all the trust it lost along the way? I guess only time will tell.